Welcome to the new age of risk, diligence, and growth presented by Strategex. My name is Maggie Graham. I am Strategex's Director of Marketing and your administrator. Some housekeeping things before we get started. There is a question and answer portal that I will be monitoring throughout the webinar where you can submit your questions. We'll try to address your questions in real time. There will also be a question and answer period at the end of the webinar. Plus, we will distribute a recording next week, so keep an eye out for Strategex mail. A quick intro to Strategex. Strategex is a management consulting firm based in Chicago. We're a team of veteran business leaders, analysts, and researchers united in the mission to use data and experience to improve our clients' businesses. Whether our clients are seeking increased revenue, improved margins, higher customer ratings, or increased profitability, we help clients achieve aggressive, profitable, and sustainable growth. And now I'd like to introduce you to our speaker, Anthony. Anthony is Managing Director of Strategex's Customer Due Diligence practice, a revolutionary practice area that's disrupting private equity. He has worked with over 50 private equity firms on countless transactions to prevent deal failure. Give Anthony 30 days and he'll deliver actionable strategies that help you mitigate risk and jumpstart value creation. So without further ado, please welcome Anthony Barr.
Hey, thank you, Maggie, and thank you everyone for joining today. I'm going to break down our conversation into thirds. First third, we're going to talk about risk, right? What are we seeing in the marketplace in terms of risk and how risk is changing and how investors are thinking about risk. And then we're going to pivot to diligence and how investors are reimagining their diligence workflows to address some of these new risks that we're seeing in an era of pandemic and recession. And then finally, talk about growth, right? I think one of the big blind spots with due diligence, and this has been true prior to current events, is that it's a check the box exercise. It's not always used to accelerate value creation. So we want to talk about how we can use certain frameworks to ensure that we're activating due diligence to really add value on both sides of the transaction. So that's our agenda for today. But first, I just want to say that obviously due diligence has always been important, right? This isn't something new. This is a pre-COVID reality. And that's because investors have to validate their valuation models. They have to validate their investment theses prior to committing capital. This isn't going to change. This isn't new, but the way that we're looking at it and evaluating risk has changed a bit. So over the past few months, we've had hundreds of conversations with deal makers. We've got a network of about 60 private equity firms that we work with, a couple dozen strategic buyers, and then by proxy, several management teams that we work with. And we've been staying fairly engaged with them over the last few months just to see how their businesses are doing, how the marketplace is changing. And we've learned a lot of really interesting anecdotes that we validated through some pitch book data. So as we start out this conversation, we want to begin just by sharing what we're hearing in the marketplace, because we know it's evolving so quickly, it's so volatile. I want to start our conversation with giving our POV. And I think it goes without saying, right, but macroeconomic conditions and sustained levels of volatility means that most deals are inherently more risky. That's just the way of life in 2020. But this combined with the fact that we have an entire generation of deal makers that have never invested in or let alone managed companies during a recession adds to a more risk-averse position that we're seeing a lot of GPs taking today. We hear this anecdotally in our conversations, and we're seeing it in the data. So the first thing I want to share is deal flow. So this is from PitchBook, and what we're seeing is through the first half of 2020, U.S. private equity deals were about 2,200 transactions, totaling $327 billion. Meaning that deal value was down nearly 20% versus the first half of 2019. But I think what we're learning is that this includes the full first half of 2020, and we had a pretty strong start to the year. It includes a really strong January and a pretty strong February as well before the COVID situation really accelerated in early March. So I think what was interesting is when the latest Q2 numbers came out, where we first have our first full quarter where we've been in the trenches of the current situation, we actually saw a much steeper decline. So deal flow is down about 33% in Q2 over Q2. And this is the situation that I think a lot of firms that we work with, funds that we work with, are struggling on the deal flow side. There's not necessarily a shortage of things to look at, but as we'll see later on, there's still some barriers to getting deals done. The bright side of this is fundraising, right? So fundraising is the second point we want to share today. And this is pretty encouraging because through the first half of 2020, about 100 funds still announced their final close. And that includes about $102 billion in new dry powder that was raised in the first half of the year, which puts us right on track with fundraising in 2018, right? It's nowhere near what we saw last year, which was an all-time high, but we are tracking to match 2018 levels of fundraising. Now, I think what's going to be really interesting, and as leading indicator that this may be, I think what's going to be even more interesting and more telling of LP appetite for the private equity asset class is the number of new fund starts. And that's something that we've been discussing a lot with our clients is, are you still planning to fundraise? Are you still planning to launch new funds? And that's where we're seeing a little bit more softness. You know, I wasn't able to find any firm data points out there to validate this just yet. It might be a bit too early, but if anyone on the call has perspective on this, I'd love to catch up with you afterwards and hear what you're seeing on the more the forward-looking picture of fundraising, because we tend to find that's a pretty strong leading indicator of deal flow. The thing that we have to constantly remind ourselves is that there is still about $2 trillion of dry powder out there, right? This is capital that has to be deployed. It's a matter of when, not if, right? And a few months ago, there was a lot of concern that capital calls would have to be made to help bail out portfolio companies, right? That was really a headline that we saw quite often in March and April. Fortunately, from our POV, we haven't seen that happen at the frequency that a lot of people were fearing. So beyond the fact that capital is still available and beyond the fact that there are some obvious barriers to getting deals done, what else is standing in the way, right? And we think this chart tells a really compelling story. I mean, what we're seeing is that the private equity market is just out of equilibrium, right? There's no shortage of supply. There's no shortage of demand. It's just multiples. There's a very strong disconnect in expectations between buyers and sellers when it comes to multiples, because even in 2020, we're still seeing them inch up. All-time high multiples recorded in the first half of this year. The reason for this we're hearing is because a lot of transactions that closed in the first half of the year were already initiated maybe in Q4 of last. So we already had LOIs in place or seller expectations were already baked in. So we're going to be very curious to see if this number starts coming down in Q3, right? Especially after new deals are being sourced and as we have full first year financials to maybe help sellers adjust their expectations. But that's why we're still fairly optimistic about deal flow in the second half of the year, because it's not a supply problem. It's not a demand problem. It's just this disconnect between seller expectations and multiples. And then finally, the fourth big takeaway that we're hearing in all of these conversations we've been having within our network, and I don't have firm data on this one either, so if anyone has seen anything to validate this, I'd love to connect with you afterwards. But what we're hearing is that deals are just taking a really long time to get done. You know, whereas M&A used to be a sprint, now it's more of a marathon, right? It's more of an endurance race. The bright side is that we're not seeing as many dead deals as we thought there would be. I mean, obviously there's been some very high profile deals that have been called off and they get a lot of publicity, but in the lower middle market, we're still seeing most deals are still going through. It's just taking a really, really long time. And that's a function of the fact that A, it's just harder to get things done virtually, but also for deals that were initiated after, let's say, early March, when the situation really accelerated. As great as Zoom is and as competent as we've all become at working virtually, we're finding that there's no proxy for that in-person management meeting. a lot of funds will not commit capital or are not comfortable committing capital, at least until they can have that sit down with the management team, have that face-to-face time. And in a lot of instances, that's just not feasible yet. So that prerequisite of face time is stretching out deal timelines quite a bit. But then also the diligence checklist is changing. More items are being added to it. And we've even seen a few instances on transactions we've supported where some diligence has been repeated, given that, we're in month 6 of exclusivity, particularly on the financial and the legal side, maybe redoing a Q of E, or perhaps some lawsuits popped up that we have to take a second look at. So there's things that are being sort of redundant in the process that's stretching it out even further. So that's what we're seeing in the marketplace. How does this impact the way we're conducting diligence? How is this impacting the way investors are thinking about diligence? Well, a few weeks ago, I was part of a virtual roundtable that was hosted by Axial, and it was one of maybe 12 or so people in the M&A space, and we were asked to discuss this very topic, right? What does this new age of due diligence look like? If you're interested in a recording of that, reach out afterwards. We can send you a link. It was a pretty good conversation. But after our hour together, we kind of came to 3 big takeaways. The first is that due diligence is obviously more important than ever for the reasons we discussed, but also more difficult than ever. The second is that there are probably going to be short-term changes in the way we diligence companies, but also probably some long-term impacts as well. I think the way that we're thinking about risk, the fact that the effect of COVID and now the recession that we're in will be lingering is probably going to result in some systemic ways and changes in the way we take a look at companies and evaluate them. And then third is sort of what I alluded to earlier, the fact that due diligence has to be more than just a check the box exercise, right? If it's not being used as a tool to very quickly realize operational and financial improvements post-close, then investors and consultants are missing an opportunity. Because the truth is, even if we deem an investment worthy of capital and we commit the capital, we have to hit the ground running, right? A lot of these companies are doing well, but not nearly as well as they could. There's still macro conditions that can impact their future financials. There's still a lot of uncertainty out there. We still got some major milestones in 2020 that can disrupt the forecast for a lot of these companies. So if we're going to begin managing a portfolio, we have to make sure we hit the ground running, because if we start falling behind the curve, it's going to be really, really difficult to get up to speed. So there was this sense that diligence has to be a value creation tool, not just a risk mitigation tool. I think the biggest takeaway, for me at least, I think one of the more interesting conversations we had is this whole idea of valuation, right? Is the historical way we've valuated companies still relevant? Is it still the right way to do it in these circumstances? And the group was kind of split, but the majority said yes. Looking at EBITDA as a benchmark for valuation is still the way to go. However, there is a lot more emphasis being placed on a company's cash position, right? We're paying much closer attention to cash flow statements, just as we are on income statements to understand earnings and EBITDA. And this is particularly true. The reason the group was kind of split, the half that works on transactions where it's sort of an equity debt split, those are the people that we tend to find are putting more emphasis on cash, because lenders and the underwriting process is becoming more restrictive, and the lenders are placing more emphasis on cash. So if you're going all equity, maybe EBITDA is still the primary thing you're looking at. But if you're taking an EBITDA debt split, which is how a majority of transactions are financed today, cash is becoming increasingly important. And that's not to say it wasn't important before, it's just much more top of mind today. The other reason there's so much more emphasis on cash is because we want to avoid that situation where you have to write, the proverbial check after the check. Now, in some instances, taking on debt or taking on additional growth capital post-close is part of the playbook, and that's different. But what we want to avoid is situations where we have to make another capital call to shore up a shaky investment. And that's another reason why a lot of attention is being paid to cash and a company's ability to sustain cash flow and remain autonomous without additional infusions later on. So, we spent a lot of time talking about this. So, and naturally, given the fact that it was a panel about diligence, the conversation shifted to how do we change diligence in a way to really validate a company's cash position and ensure that it's sustainable. And that's where, it's just such a natural pivot to customer due diligence, which is, the topic that we want to focus on today. At Strategex, we use customer due diligence. We've been using it for several years to help investors answer this exact question. Because what we always like to remind target company management teams about is that revenue is a vanity metric, right? Revenue is vanity. Sorry. Profit is sanity, and cash is king, right? Cash is always going to be king. And we have to remind ourselves, how do we get cash, right? Where do we generate cash? We generate cash from one place and one place only. It's from our customers, right? Unless we're buying a company for intellectual property or talent or some other asset, we are essentially buying a company for the underlying customer relationships that it holds. It doesn't matter how good the product or service is, if there aren't strong customer relationships to generate that revenue, to generate their cash flow, the company's not worth anything. So if customers are the cornerstone, then how do we validate the strength of that, the foundation, right? Well, it's simple, and it's really at the crux of what we do through customer diligence is we simply ask them. But we do it in a way that is different than just going out and talking to all customers. And we do it a way that is different because not only does it provide value for diligence, but it also provides value post-closes, which is, again, what we're hearing a lot of funds asking for is a tool they can actually use to help these companies survive and thrive.
I have a quick question for you. Are you finding your clients are seeking more than just what can be found in financials?
Seeking more than, if I'm understanding the question, seeking more than what can be found in financials, yes. But perhaps still grounded in financials, right? I think the important thing, especially in these times, is that we always have to make sure we're pegging things back to the actual financials of the company, right? A lot of these companies are kind of on thin ice. A lot of them are taking a pretty serious hit this year. So the things that we're looking at, and even like tangential things that we might not historically think of as affecting financials, things like, environmental diligence, things like understanding employee satisfaction, those things that certainly have an inherent cost associated to them, but the financial part isn't always front and center. That's where we're seeing it pivot a little bit. We're looking at all of those ancillary things, but understanding what the actual impact it may have on valuation or what the cost to remedy could be post-close. I hope that answers the question. If I didn't understand it correctly, Megan can clarify for us. So to bridge from diligence to value creation doesn't just happen, right? I think what's really important and a big learning for us has been that we need a framework, right? We have to have a structured way to approach diligence, because if we look at it just in the rearview mirror, it's not going to be very actionable post-close. So we need a framework to make sure it serves both sides of the transaction. And for us, the framework that we use is the 80-20 rule, right? We all know it, this idea that 20% of our effort generates 80% of our results, right? We see it's true in our personal lives, our business lives. We see 20% of a company's customers generates 80% of their revenue. We see 20% of a company's products or services generates 80% of their revenue typically. We see it in other facets, right? In our own employees, we tend to find that 20% of employees do 80% of the work. And with the firms that we work with, 20% of their investments, right, probably generates 80% of their returns. So it's just this law of nature that we see over and over, consistently so, particularly in the B2B space. But as prevalent as it is and as top of mind as it may be, it's still somewhat of a blind spot when we're conducting due diligence, both on the customer side, but also the financial side. So the very first thing we start with when we start working on a new transaction, the very first thing we look at is this framework, right? We understand what the customer concentration picture looks like, because what we know, and this is been true for a very long time, and it'll be increasingly true going forward, is that one of the primary reasons B2B transactions fail is because of customer concentration, right? You've got a top account that post-close walks away or lowers spend, and the investment thesis is shot, and you never recover from that, and you never get the return on invested capital that you were forecasting. Now, customer concentration is, it sounds like it's a simple metric to define, but it's really not. We work with so many management teams, or we get their management presentation or their SIM, and we start flipping through it, and they say, no customer concentration. Our largest account is only 6% of revenue, so customer concentration isn't a risk. And that's a very, superficial way of looking at it. This 80-20 framework helps us truly understand what the concentration picture looks like at a much more strategic level, rather than just saying a customer number one is only X%, therefore we don't have to worry about it. The 80-20 framework is also incredibly helpful, and it serves as that bridge to value creation because it helps us understand just how much money we lose by focusing on things that don't matter, and exactly what the opportunity cost is by not focusing on the things that actually do matter. So it's a great way to prioritize and get insight into the real drivers of value within a company. And that's really, if there were an 80-20 mantra, it would be make more by doing less. How can we double down on the parts of the business that are profitable, even if it's at the deliberate expense of doing less of the things that are unprofitable? So, it's a simple concept. It's tough to execute. So the very first step we always do in a customer diligence engagement is we fill out a template that looks something like this. We do 2 quartile analyses, one for customers, one for products, and then we cross those together to do one quadrant analysis. On the customer side, the very first thing we ask for is revenue by customer. And this could be year to date, prior year, past 3 years. We look at it a couple of different ways to understand what the story is. But what we do is we rank order customers top to bottom based on revenue dollars. We then put those customers into 4 even quartiles based on the number of customers. So let's say for simplicity, we're working with a target company that has 100 accounts. In quartile 1, we would have customer 1 through 25 by revenue. Quartile 2 would be customer 26 to 50 by revenue, et cetera. We then look at the percent of revenue that's generated in each of those quartiles. So looking at concentration, not on a per customer level, although we certainly do that as well, but bucketing them into these quartiles. And what we normally observe, and this is true across the hundreds of times that we do this analysis a year, is that the numbers that drop in here are typically 89% in quartile 1, 7% in quartile 2, 3%, and 1%. And again, I mentioned we do this hundreds of times a year. These numbers really don't deviate a whole lot more than plus or minus 5 points on either side. Every now and then you might get a bit of an outlier, but 90% of the instances we work with fall under that curve. The next thing we do is we look at the percent of cost, effort, time, overhead, whatever the metric may be, that it takes to service those customers. And this is where it pivots from being sort of trivial to very, very strategic. Because what we find over and over again is that a lot of companies treat customers the same. Meaning, if I have 25% of my customers in quartile 1, and I have 25% in quartile 4, I spend just as much time and effort in quartile 1 as I do in quartile 4. Even though quartile 1 is 90% of revenue and quartile 4 is usually less than 1%. So we have a very egalitarian way of approaching customer service, right? We want to treat all customers exceptionally well all of the time. And we fall into this trap of treating everyone the same, even though we know they're not worth the same. So what ends up happening when we populate this next column is we typically find that about 25% of our SG&A is allocated, not according accounting standards, but in reality, in practice, about 25% is allocated to each of these quartiles because we're putting the same amount of time and effort into each of them. So you can imagine the implications this has for profitability. If we look at the bottom half of our customer base here, right, it's 4% of revenue, but it's half of our overhead. what does that mean for profitability? Conversely, if I have my top quartile and it's 90% of revenue, but only a quarter of my overhead, it's a very different story. And this is what we typically observe. Most companies are far more profitable than they realize. They just lose a ton of money by doing things that don't matter. So it is not uncommon for us to see a company making about 150% of their profitability with their top customers. It's just being offset by the fact that we lose so much on quartiles 3 and 4, and maybe we're breaking even in quartile 2. So this starts helping us understand from a much more strategic perspective what concentration looks like, where we make money, where we lose money, what we need to do more of, what we need to do less of. So we do this on the customer side, and then we do the exact same thing on the product or service side. It's just instead of looking at customers, we're looking at SKUs or services or whatever the unit may be. And the directionally, the results are usually very similar. We tend to find it's 89-7-3-1. A bit more fluctuation on this side depending on the industry that you're in. But bottom line is you have some products and services that are far more profitable than others, and we are actually compromising our ability to maximize value creation by doing a lot of stuff that doesn't matter. Now, people look at this initially and they say, all right, well, I know the solution. We can stop right now. I need to get rid of half of my customers and I need to get rid of half of my products, right? And if you just look at it from this perspective, I get where you come to that conclusion. But there's another step in the process that is really critically important, and that is understanding the interplay between customers and products. Because the truth is, it's not one-to-one, right? The truth is, in practice, we probably have low-value customers that are buying high-value products. So why would we stop doing that, right? As long as the margins are there, as long as we're making money on that, why would we stop doing that? We also have low-value products, but they're going to high-value customers, which means they're very critical to ensuring stickiness. So why would we give that up? So it's not just as simple as looking at these two quartiles independently. We cross them together to come up with this quadrant analysis. And what the quadrant analysis shows us, excuse me, is that we have A customers that buy A products. These are our 80s buying the 80s, right? This is typically 64% of a company's revenue and 25% of our SG&A. And we call this the fort. And the reason we call it the fort is because this is what we absolutely have to defend. This is what in the diligence phase, we absolutely have to validate. Because if we lose a customer in the fort, there is going to be a material impact on the company's financials and the ability for the company to create value. We also have A customers that buy B products. So that's our upper right quadrant. And we call this the necessary evil. Why do we call it that? It's because it's stuff that we don't really want to do, but oftentimes we have to because A customers are on the line. If we get rid of something in this quadrant, but it's critical to retaining an A account, we may be putting that at risk. So we often end up continuing this segment of the business, even though it's not optimal. We have our lower left quadrant, which is A products going to B customers. And, different terminologies for this one, but, kind of think of it as a traffic jam, right? You're going down the highway, the speed limit's 70, but there's something in your, you got a car in front of you that's going 40, right? You're just stuck in this lane. You're not realizing your full potential. The only way to get out of the situation is to sort of change lanes. And that's often what ends up happening in this lower left quadrant is we have high value products, but they're going to small customers that maybe don't need as much of that SG&A that we're sinking into it. So we have strategies like e-commerce and distribution and inside sales to where we can still funnel those A products to those B customers without carrying all of the overhead. And then finally, we have our lower right quadrant, the CRAP acronym for can't realize a profit. These are the customers that don't matter, buying the products that don't matter, the services that don't matter. And we typically find that it's virtually impossible to make money in this quadrant. This is where we sink a ton of, we burn through a ton of cash, and it's just sort of a black hole. No matter what we do here, we tend to find there's nothing that is going to make this salvageable and get it to a margin level that is acceptable.
Anthony, before you continue, I have a question.
Okay.
What if you only have one product or service? Does it still make sense to do a product quartile?
Yeah, so I think that's an instance where we would have more questions than answers at this point, right? I mean, I think there's a lot of companies we work with that say that. And in fact, the example I'm going to share in just a moment is when we did this for a software as a service company. And they said the exact same thing. I have one software tool. It's on a monthly recurring revenue. I sell one thing and that's it. But as we start asking questions, we understand, well, yeah, you've got one software product, but you've got a dozen different modules that they can add on, each at different price points. Oh, you also do implementation work that you charge at an hourly rate. You do training, which you can do as an add-on to your monthly fee. And you do custom development that you do on an hourly rate. So even businesses that historically we think of as being pretty simple on the product side, there's often ancillary services or add-ons or other offerings that I think are still worth looking at in some instances, because we may find, and in fact we did find, and it's a great question. It's very related to what we're going to talk about in just a moment. We may find that some of those ancillary services are good for some customers, but not for others. And again, happy to follow up in more detail afterwards to talk about that in specific to the instance you're referring to. So this is the first thing we do, right? When we think customer diligence, we typically think, hey, let's call a couple customers, get on the phone, do a reference check, make sure you're happy. That's one way to do it. That's a bit short-sighted, we would suggest. We would say before you even start thinking about talking to customers, you have to understand what this template looks like, because it determines who we talk to, right? Once we know who's in the fort and we realize what the numbers are around this, the financials, we quickly realize this is all that matters, right? We only need to understand a segment of the business in order to feel good about the investment and in order to validate our investment thesis. Because again, we have to ensure this is secure. Without this, we're buying nothing, right? And these are some of the common objectives that we cover to determine if the fort is secure. So this is where we conduct in-depth interviews, very, very thorough in-depth interviews with decision makers at the target company's accounts in the fort. And we ask them things like Net Promoter Score, right? Net Promoter Score being the industry standard metric in the B2B space to quantify the strength of customer relationships. We determine if the account is at risk. So at any point in the interview, does the customer explicitly tell us that revenue with the company is at risk of going away or going down? And if so, what can we do in those first 100 days to really ensure that relationship is retained? We also look at the company's future growth outlook, right? Looking at the runway that we have within the fort. Are we already maxed out, or is our wallet share only 20%? And even though they're in the fort, there's still a lot of untapped opportunity to organically grow this segment. And then also, anything, it's not a cookie cutter approach, right? I mean, yes, there's certain questions that we like to ask because we find they're very predictive of success. But the benefit of doing this through in-depth interviews and not some static web survey is that we have the ability to tailor the conversations to address other facets of the investment thesis. So if we have some new product concepts that we think are really key to accelerating growth, we can put those concepts in front of customers, get their reaction to it, validate that our new product development pipeline is on point. A very common thing, right, in buyouts, especially with some lower middle market companies, we know that often results in management team churning or other key person risk. So it's a great opportunity to understand, is the customer actually loyal to the company, or is the relationship just with that key person that may or may not be there in a year? If it's just to that key person, what can we do to start proactively becoming more engaged, strengthen the relationship with the company directly, introduce a new account manager so they have time to nurture that relationship. So come a year and that key person leaves, we can still count on the revenue. Competitive benchmarking, right? This is often something, and one of the big benefits of using third party to do this type of work is we're able to collect more sensitive feedback than the company would if they were to do this type of work themselves. So as a third party who has no skin in the game, we can say, who else are you working with? What's your share of wallet? What do we do better than the competition? What does the competition do better than us? What should we emulate? In the past year, have you given business to the competition instead of us, and why? What can we do to get more of that business going forward? So we can use it as a way to really understand the competitive situation and insights to steal wallet share. So it's a very tailored process and set of questions to ensure that we're serving both sides of the transaction, right? Very diagnostic in terms of understanding, a health check of customers in the fort, make sure there's no immediate concentration risk there, but also very prescriptive because we get exact feedback from customers as to what we can do to help grow post-close.
Anthony,
Yes.
I have a question.
Yes.
When would you make an exception and interview people outside of the fort?
Yeah. So let me actually go back just a slide to answer this one. So, typically, one way to simplify it is, let's say we go back to our quartile analysis, going up here, and we've got 89% of our revenue tied up in those top 25 accounts, right? Does that mean everyone in quartile 2, 3, 4 is worthless? No, of course not. Buried somewhere in there may be strategic accounts that we have an opportunity to grow, right? We kind of use like a whale and minnow metaphor. Quartile 1 are whales. They're already big, right? In quartile 2, 3, 4, we have a lot of minnows, right? They just don't have the DNA to ever become a whale. They're in the wrong industries, or they're being really hit hard by the current recession, other factors that are just going to impede their ability to grow. But buried in there may be some, baby whales, some key accounts that we think are in the right industries, have the right conditions. They're sort of like a lookalike model for our current whales. And we handpick those and say, all right, these are the very, very few that we really deliberately want to grow. We're going to do very deliberate target selling into these accounts post-close. So let's use this opportunity now to understand how we can make that happen faster. So there's an argument to be made for having some customers built into your diligence that are not already in the fort, but we're usually very selective about how we do it. And we really push target company management teams to think really hard about who they think they can grow. All right. So conducting diligence through this framework, as you can see, it really helps focus in on the parts of a business that matter, which means the results are much more actionable post-close. This is how we make it more than just a check the box exercise, because we use that framework not only to design the diligence work, but to activate it post-close. So I want to share an example. This is a couple years ago. The software as a service company that I was mentioning, I want to share an example with you of how this actually all comes together. And spoiler alert, instead of making you wait till the very end to see the impact, we're just going to give it to you up front. This was an instance where the impact of using this framework and this 80-20 way of thinking actually resulted in a $12.5 million reduction in the size of the equity check in the transaction. And we'll see why that is in just a moment. We found that there were a lot of at-risk relationships, and the acquirer was able to use that as a way to go back to the seller and say, look, these relationships are not as stable. There is significant revenue risk. It's going to take a lot of time, a lot of investment to shore these relationships up. So because of that, we're still interested, but we have to reduce the size of the check. And the seller, understood, and they still went forward with the deal, even at the $12.5 million haircut. Some of the very simple changes, some of the very simple recommendations that came out of the diligence work were put into place. And in the first 6 months, the first 100 days, the now portfolio company actually realized a little over $1 million in operating income improvements based on the feedback that was generated during the customer diligence process. In the first 6 months, they made their first add-on acquisition, which we'll talk about in just a moment. And since then, they've made a total of 3 add-ons, all of which have no impaired goodwill. So their ability to add companies on had been extremely effective because it was based on customer feedback. And then finally, their net promoter score improved 45 points within a year. When we did our initial assessment, I think they were at a net promoter score of 15. And by the time we finished, they were closer to 60. So very, very rapid improvement, both in financials, value creation, and the state of relationships. And I think that's sort of like the trifecta that we're going after. Because a lot of playbooks that we see include a major cost-cutting component. The challenge there is when we cut costs, it often comes at the expense of jeopardizing customer relationships. Right? We cut cost in tech support, we cut cost in customer success, we cut cost in implementation and training and all these other ancillary services that we mentioned with the SaaS company. When we do that, we're taking away from the customer experience, right? We're not setting customers up to succeed. Meanwhile, the competition may be investing in those things. So we often damage customer relationships in the process of executing the standard private equity playbook, which is why in this instance, the fact that we were able to do this and strengthen relationships as measured through the Net Promoter Score at the same time was a huge testament to the efficacy of this framework. So how did we do this? How did we get these results? Well, first, as is always the case, we get the data. This, I kind of already alluded to it, I think, through one of the questions that was asked, but this was an instance where we were working with a Philadelphia-based private equity firm. It was a platform investment and a software as a service company. And the company essentially has a CRM product, but it's for a very niche industry. To the point where like a standard Salesforce or some other more well-known CRM just doesn't make sense, because it takes so much development to get it to fit their specific needs. So the target company really differentiated themselves as being a full-featured CRM, but specific to this very niche, very fast-growing industry. And that was the attractiveness of the investment, is there really wasn't a whole lot of competition. The thesis was that since they're the only player out there that's in this space, sure, the company might not be perfect, but relationships are still pretty sticky. And they also said there was no concentration risk because, again, the top account was only 6 or 7% of revenue. So that was the intro call we had. And frankly, we didn't believe it because we hear that almost all the time. So we asked to see the data, and we got revenue by customer. And sure enough, this is what it looked like, right? That top quartile was not 89% of revenue like we typically observe, it was 86. So still within that threshold. And again, it just reinforces how amazingly consistent this 80-20 rule is. Within B2B, across industry, 89-7-3-1 is almost always the pattern that we see, and directionally it's the same, even in software where people typically think they buck that trend. Gross profit was what we looked at next. Makes sense that directionally it follows revenue. SG&A, when we took a look at their customer journey and their customer experience, and we started asking questions about how they treat customers, sure enough, they kind of fell into that trap where all customers were being treated equally. They didn't have key account management in place. They didn't have service tiers in place. There was no like platinum, gold, silver way to segment customers and give them different experiences. When customer number 1 called with a tech issue, the exact same thing happened as when customer 440 called with a tech issue, right? They dialed the same number, they went to the same queue, they got the same person, they had the same wait times, they had the same resolution. There was nothing to discriminate the value of the customers in terms of the experience. So they were spending an equal amount of time in each of these quartiles, which means the bottom line on profitability directionally is, while this was a company that thought they were making about 8.5 million in op income, they were actually making 10. They were making 10 in quartile 1, but they were losing about 1.5 on quartile 3 and 4, and then just barely breaking even in quartile 2. So that framework certainly held true. Once we knew what this situation looked like, then we can do effective customer due diligence, because the truth is the next step is to interview the customers, but only the customers that matter. And this is where I can get on my soapbox and talk all day about methodology. And this is going to be probably a bit of a controversial statement, but when you're doing this type of work, sample sizes don't matter. Sample size is the way we traditionally think of them, right? If we were to look at this, the traditional way of scoping out methodology for a situation like this is we would look at the fact that we have 440 customers, and we would calculate the sampling error, and we would say, all right, if we want a confidence interval of 90%, we have to do 300 interviews. That's the only way to get a representative understanding of what's happening with this company. And we say that it's fundamentally flawed, and it's fundamentally flawed with almost all B2B companies. The way to think about it is thinking about representativity of the revenue base, not the customer base. And in this instance, only 110 customers were 90% of revenue. And in fact, 50% of revenue was generated by 32 customers. So it's still representative. It's just a different way of thinking about it. You don't need to go out and interview everyone, because the truth is everyone isn't created equally. There's certain customers that matter a whole lot more than others, and that's where we focus our resources. Beyond that, we also take a hybrid approach, right? Sure, there's web surveys are great for getting us bigger sample sizes, allowing us to cut data by region, by product, by whatever. But response rates are so low. You know, best case scenario for a web survey is you get a response rate of maybe 10. I mean, if you're really, really lucky, maybe 15%. If you only have 15 customers that matter and you do a web survey, I mean, you're lucky if you get one or two of them. So you have to take a different approach when you're doing this type of research. You have to do live, in-person, in-depth interviews. With those in-depth interviews, you get a much higher response rate, you know, closer to 70, sometimes even 80%. And you also get a much more engaged conversation. It's not a 5-minute web survey. It's a 30-minute conversation about the state of the relationship and about what the opportunities are to grow post-close.
Anthony.
Yes.
I have a question. Should you 80-20 the top quartile?
Yeah, that's kind of what I was alluding to earlier, is we look at it by quartile, but the truth is within a quartile, there's a quartile, right? Not uncommon, you know, we talk about 80-20. 550 is kind of also a rule that we see becoming more and more prevalent. 5% of your customers may be upwards of 50% of your revenue. So while this is again, it's a framework for looking at it, we always take a look within there to see what the spread is, right? Not uncommon to see, you know, especially with some bigger customers, not uncommon to see customer number one maybe being 10 million, but even the last customer within quartile one may only be 100,000, right? Sometimes the spread might be that significant, in which case we would take a more precise way of conducting the interviews, still focusing on those very, very top accounts, but then using, as I mentioned, the web survey to still kind of capture that longer tail. All right, once we collect all this data, once we conduct these interviews and get all the quantitative and qualitative data, then we have to analyze it. But we have to analyze it from both a diligence and value creation set of implications in mind. And what I mean by that is this idea that it has to be diagnostic, it has to give investors peace of mind, confidence in the transaction, but it also has to be prescriptive. It has to serve that bridge to value creation. So what I've got up here are just a few of the key takeaways from this project that we did with the SaaS company. Their net promoter score with quartile one customers only, right? Those top accounts, their net promoter score was 15, which on an absolute basis is not a very good score at all. And relative to the SaaS industry average, is considerably lower of the average of plus 41. So we knew right off the bat, these relationships were not as stable as they should be. Beyond that, we actually identified 8 specific accounts that were all considered to be at risk, meaning they explicitly told us at some point in the interview, their spend with the company will be declining. And that's really the leverage that the fund used to negotiate a lower purchase price. But that's the diagnosis, right? What's the prescription? What do we actually do to make this better? What we found were 3 themes. The first is that the software lacked an integrated marketing email tool. So if they wanted to send emails out of their CRM, they had to export the list, import it into another tool, send out the emails, and then they had to export all the open rates and click rates and import it back into the CRM. It was kind of a mess. It was a huge pain point. Competitive offerings had an integrated solution, and this was the #1 reason customers said they were dissatisfied and considering leaving. The second reason is because reliability and uptime were probably closer to 85%. Rather than 99% plus, which it should be for SaaS, right? When we think about SaaS, reliability really is the base of the pyramid. They didn't have acceptable levels of reliability and uptime. And then the third, and I was talking about the fact that we're able to kind of find all the skeletons in the closet when we do this. The third issue that came up, and this was mentioned by almost half of the customers we interviewed, is that the head of the implementation team was a huge risk, and it was really compromising relationships. And being one of the first people they talked to in the customer journey really tainted their whole experience and put them down a path that was less than optimal. This quote, this is an actual quote from one of the top customers that we interviewed. And no offense to any children of CEOs here, but the quote is, "One of the most incompetent people I have ever met. He must be the CEO's kid because there's no reason he should have the job he does." So we identified three major weak points in the customer experience, but three very actionable points in the customer experience as well. And it can serve as that bridge to post-close actually implement strategies to secure the fort. So what did they do? Well, within the first 100 days, they implemented key account management at those 8 accounts that were at risk. So each of those 8 accounts got a dedicated account manager. They were on the ground with them, working through the issues that they had, building up that engagement. And now 3 years later, since we did this initial platform investment, all 8 of those accounts are still active with the company. So they were very effectively able to secure that revenue base, which was significant. I want to say those 3 accounts combined were almost 20% of the company's revenue. Within, as I mentioned, within the first 6 months, they made their first acquisition. That first acquisition was an email, a marketing email add-on that they quickly integrated into the software product. And now they have fully integrated marketing email. Customers love it. They get fantastic feedback on it. And it really alleviated that major pain point in the customer experience. The company migrated from a private to a public cloud. So instead of maintaining the servers and the infrastructure, they shifted it over to Amazon Web Services, which is far more secure, far more reliable, and a whole lot less costly to maintain. They were sinking a couple $1 million a year into maintaining their own infrastructure. And now with Amazon Web Services, it's a fraction of that. And of course, they did replace the implementation lead. And today the company is, as I mentioned, a really drastic improvement in Net Promoter Score in a year. They're today at plus 60, which is 19 points higher than what we typically observe with the industry average. So then finally, once the fort is secure, once we validate that those relationships that matter are sticky, they're not going anywhere, we can count on that revenue, then we focus on optimizing the other quadrants. In this case, the first thing we did is we looked at quad 4, we looked at the crap, and we recommended that the company let those customers go, right? They're not going to be profitable. But at the same time, that's hard. We were talking earlier about what you're buying when you buy a B2B asset is relationships, right? And relationships are inherently emotional. So we can make recommendations all day long about getting rid of customers or getting rid of products, but we know ultimately it's an emotional decision. And in this case, we made the recommendation, the company didn't take it. So we said, fine, you have to at least raise your prices. You have to raise your prices among quad 4. You have to put in monthly recurring revenue minimums, so that at least we're not losing money on these customers. Let's at least try to break even, get a couple points of margin out of them. And by raising prices in quad 4 alone, they added a couple points to op income in the first year. The traffic jam. This is where I was mentioning, they had no way of stratifying the customer base. They didn't have different tiers. They didn't have different levels of service. So we implemented that. And we said, if you're an A customer, if you're in the fort, you get our own in-house implementation and development and training and tech support. However, if you're not in the fort, if you're a B customer, we still want to sell you our product. We still want that recurring revenue, but you have to work with a certified third party to do the implementation, to do the training, to do the support. Right? You have to have a separate service contract with them. You can still use our software, but we're not going to carry the overhead of servicing you, Mr. B customer. That just doesn't matter. And of course, we don't position it this way, but these are the strategies that we help execute. And then finally, in the necessary evil, right? The one that's always the most tricky because A, relationships are on the line. In a large part, we continued to do quad B. We just became more selective about what we added to it. So the company had about a dozen things on its new product development roadmap, and we winnowed that down to just 3, right? 3 things that A customers actually wanted, so that we didn't sink a lot of R&D into building more B products and modules that may be interesting, but really didn't have any in-market potential. So this is what we've been doing with this platform over the past 3 years, and they're gonna exit, they were planning to exit 2 years early when they initially modeled the investment. They They were thinking a 5-year hold period. They're happy with where they're at. Today, they're getting a 35% higher return on their capital than they initially forecasted. And they're getting ready to go to market. Now, of course, the current situation has put that a little bit on pause, but they are in a much better position to exit faster and at a higher return by just doing some of these simple things that are all informed by customer feedback. I think this quote from the lead partner that's on the deal, and also a board member of the company, is really a testament to the power of conducting your customer diligence through this 80-20 framework.
Anthony, real quick, I have another question.
Yeah.
By focusing on quartile 1, aren't we missing an opportunity to grow smaller accounts?
Yeah, so I think that's kind of tangential to what we were talking about earlier. When does it make sense to interview someone that's not in the fort, right? And the answer is yes, but we have to be really, really selective. This goes back to that whole, whale minnow metaphor. We've got our whales today. That doesn't mean everyone in quartile 2, 3, 4 doesn't matter. There may be a handful of strategic accounts that we have an opportunity to grow, but we just want to be really strategic about pulling them out, treating them differently, giving them the chance to grow up. Because the last thing we can afford to do is hope that happens with everyone. Because we'd be fooling ourselves. We know not every customer will be $1 million account. There are always going to be some customers worth less. It's an art and a science of figuring out who in quadrant 2, 3, 4 do we want to isolate and really invest in growing. And that's where you can mitigate the risk of blocking out some of those high value accounts if we take a very deliberative look at our customer base and understand who we want to treat differently. And again, if any of these questions need more explanation or you want to discuss in more detail, here's my contact info. Would love to follow up with you afterwards and discuss in more detail.
I have one more question. How does the customer optimization strategy change during a crisis?
Yeah, so I think that's really where we're talking about, cash is king right now. If we are not 100% sure that the fort is secure, all resources have to go into that, right? If there's even one top account that may be at risk, all efforts have to be put into ensuring that they stick around, that we don't lose that revenue, because they're the ones actually generating our cash. Customers in other quadrants, once we get through this, sure, there's opportunity there, but today chances are they're more of a cash burn than a cash generator. And in many instances, especially in quad 4, if you lose those customers, you're actually better off, right? Now, we never want to do it in a way that does any damage to our reputation or our position in the marketplace. But this whole notion of making more by doing less is really what this framework is all about. It's doubling down on the customers that matter, even if that's at the deliberate expense of treating the customers that don't matter differently. Not saying we would treat them poorly, but when we talk about optimizing the customer experience, that means stratifying the customer experience so that there's an actual ROI associated to it by treating top accounts drastically differently than we treat smaller accounts.